Engineering major and industry bellwether Larsen and Toubro announced its results on January 30th. Order inflows up 21%, revenue up 14%, recurring PAT was up 20%. But what's happened behind the numbers and what's the way ahead? Let's talk about that. Joining me today is the Chief Financial Officer, Mr. R. Shankar Raman. Hi, Mr. Raman. Thank you for joining us.
Thank you.
I know you've had a very busy few days with the results and budget and everything, and really appreciate you joining us. Straight off, let's talk about the numbers. Of course, are looking very good in the third quarter. What I wanted to understand from you is that if you look at the third quarter, your order inflow has gone up 21%, and for the 9 months, it's up 30%. What has driven this order inflow, and is this sustainable, or is this momentum likely to continue?
A fair question, because I think we've also been examining this issue closely from a point of view of sustainability. If you look at the trailing 9 months of the current financial year and compare it to the 9 months of the earlier financial year, the projects that were announced and fit for tender, as they say, was about 6 lakh crore in FY22. And for FY23, for the same 9-month period, April 1 to December, it was 10 lakh crore. So obviously the pie had gotten bigger in the period of 1 year. And as we normally expect, towards the back end of the term, political term, many of the projects that's conceived during the early part of the term, there will be a push on to make sure that they take off and mature into better outcome for someone to look back and say, in 5 years, we've been able to make a difference. So the pie has gotten bigger. That is number one. Number two is the speed at which these announced projects were converted into requests for quotations have also been very brisk. This happened not only in this year, right from the time we were recovering from the pandemic, that is from 21 onwards. The government has done its bit to expedite the processes of converting the announced projects into RFPs as quickly as they could. And more importantly, crash the timeline between the tendering and the awarding. And this has really helped companies to pick pace. Traditionally, you will find that most of the EPC companies have softer first half of the year, and the activity will pick up in quarter 3 and really reach a crescendo in quarter 4. That's the normal hockey stick that we are accustomed to. But in the last 2.5 years, I find that the consistency of ordering between various quarters have improved, partly for the larger reason of boosting the economic well-being of the country, improving the sentiment of the business, etc., and helping the company recover from sort of once-in-lifetime shock to the system in terms of the pandemic disruption. Of course, things like the war in Europe, etc., were not anticipated, and the disruption that it has caused in terms of supply chain disruption has had its own role to play. But the government or the sponsoring agencies who put out these orders have also given themselves better time by announcing the awards earlier, so that the execution time gets sufficiently buffered for slippages, if any, because of all these events beyond our normal natural control. So I think the process of ordering out has improved. Third, and the most significant, is some of these orders have been sufficiently large and complex from an engineering point of view. And our company actually revels in these situations where there is engineering complexity. And the cost competitiveness of the offerings that we do improves whenever the project sizes are sufficiently large. So we've had the size of the orders and the nature of the orders also playing up to our strengths, which has enabled us to win a little more frequently than what we traditionally used to do when projects were of much smaller sizes and less in terms of engineering complexity. So all of this together has come together in the right time, and the recent budgetary announcement only endorses the fact that the government does believe in a consistent manner that investment led growth is what would create employment generation and all the multiplier benefits that this action will take. So the task before companies like us is to make sure that our resources are well mobilized and we are organized adequately to take advantage of this conducive environment. I do believe this conducive environment would continue for the next 4 to 8 quarters, given by the program that are getting announced. And we do also believe that the funding support by multilateral agencies for some of these programs, because they are large, because they are meaningful, will also continue, because I think there is global liquidity, and India appears to be a very differentiated market today. Given that positioning, I think we should be seeing sustained momentum of order inflow. It's up to us to remain competitive and take the maximum advantage, but that's our task. We need to work towards that.
That's an interesting overview. Mr. Raman, help me understand. I mean, I'm looking at the orders that you have bagged. Looks like, there's been a seriously healthy tendering and awarding of orders by government agencies. On the ground, what is the sense you are getting from your interactions with your private sector clients? Are they investing again? Is there an uptick in investment? Are projects taking off better than before? What is the road ahead on that?
I think statistically speaking, the share of private sector orders for the 9 month period, December 22, was at 35%, as compared to 25% in similar period last year. So, from a statistics point of view, I think the share of private sector orders have gone up. The sectors that have been ordering out, which accounts for this private sector orders, have been very diverse. They're not concentrated to any one sector, even though it started with minerals and metals. Most of the steel and the cement companies started expanding their capacity because of the favorable pricing conditions that they were operating on. And secondly, I think as the world got into certain geopolitical shifts, export markets opened up, and much of the steel players also benefited from the export potential that they have. So once they exhausted the capacity that is available to them through NCLT process and stressed assets, etc., the turn came for investing fresh capital. Private capital, as you know, is pretty calculative. I think they get invested when the returns are reasonably certain and the investment sentiment is positive. So unless the boards of private sector companies see a 2 3 year runway of stable returns, I think the sanctioning of capital expenditure does not happen easily. And I'm talking about responsible sanctioning. People who
Right.
want to do it on a whimsical manner is another topic by itself. But given that the environment turned conducive, then the next to follow was the automobile sector. As the energy transition happened, I think the electrical vehicles became hopefully people's preferred choice, and hence people started investing to make sure that they are prepared for a trend which are 3 4 5 years ahead. But the preparatory work need to happen now. So I think the ordering out by automobile companies started. The third thing that picked up is as infra investments picked up, companies which are into ancillary construction products like mining equipments, construction equipments, paints, all of that became the need was sufficient that they have to expand their capacity. They started putting in their capacity expansion. The big shift, however, happened when the energy transition really took off. I think the de-emphasizing on coal meant that to meet the growing demand, alternate energy was required. So solar became a preferred investment mode, and the government was encouraging policy-wise and otherwise the investments in solar sector, and so the solar investments picked up, and that was largely from private sector. To add to this momentum, the international, particularly the Middle East, realize that they are so blessed with a very high quality sunlight, and hence their potential to convert with minimum loss of energy was much higher, and they started, led by Saudi Arabia, they started investing big time in solar projects. And that was also done through the developmental mode, as what we call as PPP in India. So they were solar developers, developers of solar parks, who were supposed to generate these green energy. And L&T, being one of the largest EPC player in the solar area, obviously got preferred qualification, and we have won some orders. And fortunately for us, these orders are sufficiently big, unlike in India where there are, let's say, 50, 75, $100 million orders. These are dollars, 1 billion, 1 billion and a half, etc. So they've also added up. So combination of these sectors help the private sector to pick up. And off late, we see the momentum for large format data centers is picking up. I think much of the hyperscalers are investing in India fairly significantly, and the data centers have to be built and built reliably. And given it's just not a building; it's a fairly sophisticated building. To be able to do all of that, I think contractors like L&T will have an advantage, and so they also contribute to the private sector order. And finally, the public spaces have also started investing. I think there is a definite shift towards improving the experience of the traveling public. The airports were the first ones which actually modernized, and those continue. The airport expansions continue. These are all out of private sector balance sheet. Now there is a move to make the railway transit also to be superior in contrast to what it is today. So those also would be put out in PPP format. So I think that will again provide an opportunity going forward. So I do see that as sectors are picked up for private participation and the enabling policies are triggered, the private sector investments would flow. But surely the size of public sector investments or the government investment will be larger, because they address a much larger purpose as compared to a private sector. But I think it is healthy. It's in a healthy zone to have 25% of the orders or 30% of the orders coming in from private sector. Definitely helps the EPC companies like us.
Mr. Raman, in the last many quarters that we have been talking, this is the least, as you put it, cautiously optimistic. I have seen you. I see more of optimism than caution right now. But what I'm not able to understand is that, in the first 9 quarter itself, your revenue and order inflow growth has been rather strong. And when you addressed media right after the results, you said that, if this momentum continues, you may exceed the order inflow growth and revenue growth target that you had earlier given for the fiscal at 12 to 15%. So what is holding you back? What is it? Is there still some concern why you are not really revising these targets? Because the fourth quarter, like you earlier said, is really the strongest quarter. The momentum in the government space seems to be going strong. Private sector, you are saying, is looking up gradually. And there is a big bang announcement on the budget front, which is a very capex heavy budget. So what is it that is still holding you back?
Nothing really, Rachita. I think we'll have to see quarter four being very strong in the context of relatively weaker first half. Now, that's been the tradition, right? The first half will be weak, and the third and the fourth quarter will be stronger, and the fourth will be the strongest to reach the targets that we set ourselves for. Now, in contrast, this year the growth has been more uniform. Just because the growth has been more uniform, it doesn't mean that it will retain the same trajectory of a strong quarter four, which normally backs up a weak quarter three, a weaker quarter two, and a very insipid quarter one. So we cannot cut paste the strong quarter four of a year which is back ended to a year which is more uniform. We do think that much of the work that we need to do for the year is behind us. So to that extent, when we give a guidance of a range, and in this case, we had given a guidance in the range of 12 to 15%, and we are coming back to say that there is a good possibility, if there are no surprises, that we will meet the guidance upper end and even exceed if all goes well, is, I think, a strong indication of the environment that we work in. We're not being extra cautious or extra pessimistic. But we must also remember, in project business, the contracts do not increase just because quarter four has arrived. The contract is given. It is the question of sequencing the work that we do. Do we do 25%, 25%, 25%, 25% in 4 quarters? Or we do 15% in first quarter, 20% in second quarter? Likewise, do we build up? The past experience has been a gradual build up. The current year's experience has been more uniform. So it is unlikely that the contracts will have headroom for us to over exceed, because we will stop when we reach the end of the contract and the scope is completed. The orders that will follow as a result of this very strong budgetary announcements, you will see it play out in the second half of 24, FY 23-24, because it's going to take 6 months for the details to be ironed out, the respective ministries to get comfortable with their allocation, to do their prioritization. We find even out of this 10 lakh crore, about 2.6 lakh crore goes to Ministry of Surface Transport, for 2.5 lakh crore or 2.4 lakh crore going to railways. Now they have to work on the details on what their priorities are, and then convert it into RFPs, pre-qualify people, and invite for quotation. So this process is a little long drawn. So I would think that the benefit of the current year budget will play out in the second half of 23-24, maybe more closer to the run up of the next general election. And assuming there is no discontinuity in all these programs, you will see that resulting in a fairly strong 24-25 as well.
What about, I mean, the pipeline looks strong enough and you have a huge order backlog right now. But what about the margins? That was the only slight dampener in the quarter
Yeah.
because there was a contraction there. Uh,
Yeah.
is is that a concern going ahead? I know you have repeatedly said earlier that you're not in a quarter to quarter business, but help me understand, how are the margins panning out, and is there some relief on that? Because while the uptick in the metal business might be good for you in terms of the orders, but you're also placing orders for metals at a higher cost. So how does it pan out then?
Rachita, we actually bid ahead of time, right? I mean, today, if I submit a bid, it is for implementation over the next 2 years or 3 years. So, an assessment gets done on what could be the cost line, and we make that extrapolation when we finalize our bids. When input costs increase and increase beyond what we have factored in, is when the margins begin to take a hit. As we see, the projects that we are executing now and reflected as revenues are projects where we had committed the costs, the input costs, with our various vendors and supply chain partners in the last 12, 15 months. Now, last 12, 15 months, you know that the inflationary pressures were pretty high. And even though more recently things have cooled down a bit, but the projects we are executing, unfortunately, has the costs of those period. Now, we also have a situation where we incur the cost today, account the cost today, and then the margins are reported appropriately lower. But when the project comes to an end, we have an opportunity to sit down with the customers and try to work through the price variation clauses that are embedded in the contracts. And some reimbursements will be due. Those reimbursements would be done after the recognition of the cost and the revenues out of the contract, and it will pop up in a quarter where there is no other revenue or cost line associated with that concerned project. So since we run such a large wheel of order backlog, there will be at all times projects which are executed which has a bit of a disadvantage in terms of cost, and there will be projects which will be actually throwing up some price variation claim settlements, which is disproportionate to the work that we do at that point in time. So this lead lag that we operate in project business actually continuously plays out. We are in a cycle now where we are absorbing the cost contracted during the high inflationary period. The projects that we will bid out now, or we are bidding out now, take into account the higher base cost. And if the prices do not rise the way they rose in the last 2 years from this point in time, it is quite likely, and if let's say the prices soften, it is quite likely that we could report margins a little better than what we had anticipated getting into the job. So in our business, it is very difficult to actually structurally draw out inferences based on these quarterly reporting. But as I keep saying, if you take a very long term view of our margins and see over the last 10 years, 15 years, what we have done, despite several economic cycles, we have been fairly stable in our margins. Give
Right.
and take 100 basis points, our margins have been pretty range bound. And this stability was obtained only because of the cycle of contracting cost at one cycle, executing at another time, and getting reimbursed at the third time. So this cycle, so long as our contracting does not become completely fixed price and does not have price variations embedded, I think these are self correcting as we go forward. I do believe that the margins will look up as we exhaust the current set of contracts that we are executing. The margin profile will look up because the contracts we won in the last 6 months obviously were better priced, taking into account the inflated material costs.
Mr. Raman, just kind of getting into the inflationary pressures that we have been seeing, and every RBI policy, we expect probably this would be the last of the hikes. And what is your expectation now? Another 25 BPS next policy? Do you think there will be a further hike, or do you think they would be happy with these levels? What is your take on it?
I think growth has come back on the agenda. And to that extent, I think we've had good rural economy situation. So I think if we are able to create employment, generate wage earnings, I think the government, I think, would stop tweaking the monetary policy significantly beyond maybe 25 basis points, etc. Is, I mean, the people in Reserve Bank and the Monetary Policy Committee will possibly know better. But from a very broad brush basis, I don't expect the interest rate to significantly go up from here. And if we are able to return back to this 11.5% nominal growth that we are projecting, I think it factors the current cost of capital. And the banks are reasonably in good shape. Their balance sheets are in good shape. Deposit growth has been pretty handsome. Of course, we'll have to see the recent announcements that I've made in small savings, etc., the enhancements that have been given as to how much of that affects the flow of bank deposits. We need to see, wait and watch. But having said that, I think the banks are reasonably comfortable to fund viable projects at these current costs. So I think the interest rate hikes have peaked out, in my opinion.
Mr. Raman, the other development that one is seeing, and it's a little alarming, is the kind of layoffs that we are seeing in the IT space, and even in the startup space, the technology in sector in general, massive layoffs happening, and there are fears that it might get worse. On this, I want to ask you two things. L&T, of course, is pivoting towards a structure where ITs and IT services have become very important and will continue to be very strong. So, how is that business looking? And also, traditionally, every time we have spoken to L&T management, the engineers leaving core sectors and going to technology has always been an issue. Does this always give you an opportunity to kind of get young talent into core sectors? So, two questions on that.
Okay. See, the large layoffs are happening in sectors and companies which hired like there is no tomorrow when the pandemic hit. I think what sometimes misses our attention is that excess hiring that got done. Once the world has gotten ahead of the pandemic and there is reasonable comfort now that it's behind us, then people begin to question the kind of talent pool that they've assembled for their business models. Because I think while world has irretrievably turned towards e-commerce, it cannot be just digital in isolation to physical. That realization is possibly dawning. So the fluff that were there in the employment system is going away. But as far as the IT sector is concerned, the IT services sector or the IT product sector is concerned, I think there is a genuine demand shortage. Because I think much of the businesses are in transition, either in terms of their IT infrastructure or their business model itself. Much of the IT work that is coming the industry way is transformative in nature. In fact, many of them are becoming outcome based. That is there a way to improve the competitiveness? Is there the way to improve the user experience, etc., etc.? These are terrains that are very customized to a particular business, and we have not been in this space, so it's difficult to assess the kind of resources that are required. But very clearly, I think as the world gets more and more into the artificial intelligence and the robotics and automation, the skill that is required is very different from the code writing. So much of the layoffs, if at all, or shift attrition is happening in the code writing space, where I think it is profitable to employ fresh graduates who cost that much less than to have somebody 15 years experience writing the same codes. It doesn't make economic sense. And unless those people have acquired skills to graduate into the next level of responsibility in these organizations, some amount of attrition and shift is inevitable. What we need to deal with as a core sector industry is the preference to work in sites, to get excited about working underground, complex engineering structures, etc. Now we do find that as employment in distant shores become more subjected to this hire and fire mode, while most certainly it's very exciting to work in Western markets. But I think the work conditions and the methodologies and the practices are also equally to be acclimatized to. And there, you don't know, come Monday, whether you will be in employment, you don't know. India provides stability. So we do think that, and secondly, the startup ecosystem in India has also helped in retaining some talent. I would like to believe. I think many engineers are not by default going to US or UK or anywhere. They're also exploring other options in India. What this does is it creates a certain retention pool in the country, and it is up to companies like us, for example, to create excitement for young engineers, because I think people today want to work for a broader purpose. I think having an employment and getting dinner on the table is a base requirement that everybody requires. But are we contributing something significantly to change the ecosystem, be it changing the infrastructure landscape of the country or its own technical powers, is something that the younger generation, the current generation of youngsters who come into employment are concerned about. And that is why you find NGOs are able to attract the brightest of minds today. And not because they pay well, they can't pay as well, but the broader purpose is served. So I think companies like us who actually build India, why India, who build whichever region that we work in, I think have that to offer. And if we can build on that and keep showcasing the complex stuff that we do, the coastal road in Mumbai, the city you and I live in, I think will transform the commute experience of people. So if you look back and say who created it, was it a piece of cake or was it technically very challenging? I think obviously the answer, the vote will be for technical challenges. And fortunately, we are a company which offers virtually university of engineering skills. We are into mechanical, civil, electronic, electrical, chemical, metallurgical, defense. We are into all areas of engineering. So a person can virtually choose the field that he wants to work in, provided we also do the engaging part. So I think it's a give and take. Two way takes two to clap. I think the employers will have to do their bit to attract and be relevant for the incoming crowd, and the incoming crowd should invest time to get returns on their time invested. So I guess it's an evolution.
Interesting times for sure. Before we wrap up, Mr. Raman, one final question. We are almost towards the end of this financial year, and I know you will be getting into the budgetary exercises for next financial year if you have already not started. But so I want to just ask you one last question. What is the next fiscal going to be for you? I mean, what is the strategy that you are looking
We
to
we've
take ahead?
Rachita, when we did the strat plan, 5 year strategic plan, we have defined the
Right,
the goal posts for FY26. And
right,
what we said, and we did this in FY21 on the back of FY21 results, we said we'll double our revenue, and we will also more or less double our order inflow. What that means is to achieve 15% growth on the revenue. And if you're able to do that and complete the divestments which actually were producing sub par returns on the asset invested, keep our working capital light and moderate, we were saying that we should be able to move towards the return on equity, which was 9% in FY21, to something like 18%. So this is the path that we have set for ourselves. So with each passing year, we are 1 year short in reaching our goal. So what you will see us do in FY24, FY25, FY26 is move towards this. So far in FY23, we have ticked the boxes, I
right.
hope. And I think we will reach in line with our plan. The roadmap for 24 will have to be re-endorsed, and our budgeting process will do that. And we cannot lose sight of what 25 has to be and what 26 has to be, because we can't leave too much for the slog overs. We have to make sure that we are consistent and don't create trouble for ourselves in increasing the ask rate very stiff in the last year.
So consistency would be the key word. Best of luck for
Absolutely.
that,
Thank
Mr.
you.
Raman, and thank you so much for your time and perspective. And of course, we'll continue to be in touch. Thank you for joining us today. Thank you and
Thank you very
bye-bye.
much, Rajita. Thank you. Bye.